Alright, welcome to Personal Finance 2. We're going to do your final review, so feel free to print this out and have it there and kind of follow along. We'll just go through this quickly. Feel free to fast forward and rewind as necessary. Alright, number 1. Explain what it means to use the time horizon that you will need your funds for as a way of determining what type of investment you should use. So what I'm wanting here is something to the effect that different investments have a different timeline of return, right? So that's one thing. So if you need your cash in the next year, you may not want to put it in the stock market because it could be down for the next 2 years before it goes up. So it kind of incorporates the idea of risk and return. That if you need your funds in 6 months, then you're going to have a different type of investment than somebody who may need their funds 10 years down the road, right? So if you need money in 6 months, first of all, you're not going to get a ton of return in 6 months. You have to be realistic. But if you need it in 6 months, you don't have time to wait on a down period, so you're going to have it be something fairly conservative and something that you can get it back out of pretty easy. And then if you need it, say you're just saving for your dream home and you're going to be saving for the next 10 years for that, then you may want something that has a higher rate of return, like stocks that you could hold on to for a long time. So something to that effect. How I want you to talk about how when you need your funds determines what type of investment you should be looking for, right? Okay. Number 2, what are the 2 balancing disciplines needed to see your free cash grow? So basically what I'm thinking here is there are 2 things that kind of are in competition. One is how much you save, right? And then the balance to that is how much you spend. That you could be a really great saver, save a lot, and because you're also spending so much on the other end, you're not getting your maximum return. So it's kind of a balance. That's why I call it the balancing disciplines. That it's not just about where you're investing and what you're putting into your investments. It's also about, on the other end, controlling your spending habits so that you're not wasting dollars that could have been invested. Okay. Number 3, list the 2 forces that can be considered anti-saving, right? So one thing that's anti-saving is inflation, right? That if you put money into a savings account and just leave it there, inflation will erode the value of that money. If you put $1,000 in the bank 10 years down the road and don't do anything else with it, inflation will have eroded that to where that $1,000 doesn't feel anywhere near like what $1,000 felt like when you first put it in. So inflation is anti-saving. Then the other thing that's anti-saving is debt. If you have $1,000 of debt that you're paying, say, 15% interest on, and then you save $1,000 on the other hand, and you're only getting 5% on your investment, then you're losing 10% every year. You'd have been better off to have taken that $1,000 instead of investing it and paid off your debt. At least you would have broke even. If you keep the debt and you save, and you're losing more than what you're getting in the investment, so you're actually going into the negative in terms of your overall effect. And so if you have high interest, it's better to pay that off first, then start saving. Because debt and the interest that you pay on your debt is anti-saving, right? Number 4, the main focus of diversification is the management of risk, right? That's why you diversify, is the management of risk. Because for the most part, if you found one really great investment that's paying you a great return, then why put any of your money in an investment that's only giving an average return? If you find something, like if you've got an investment that gives 5%, an investment that gives 10%, and an investment that gives 15%, why put any of it in the investment that's going to give 10 and the investment that's going to get 5? Why not put all of it in the investment that's going to give 15? Well, the reason that you don't do that is because if that investment that's going to give 15 fails, right, because nothing's fail-safe, if it has a bad year, something happens to it, then you've lost everything, right? And that's a very high risk to put everything all in one investment. So really the reason that you're diversifying is really the management of risk, because you know that some of the things you're putting your money into are not going to pay the same return as something else, but they're often not likely to hit trouble spots at the same time. And so it manages your risk. If you put it all in one thing, it could go really high, and it could go really low. And so diversification is not because you're going to get a higher return per se. The higher return might be if you just poured it all into one. The trouble is, you pour it all into one, your risk goes way up. And so diversification really is about the management of risk. Number 5. In your own words, list 2 important principles that you learned about investing control. So I want you to do this one on your own. I want you to go back to the videos that we did about investing control and kind of check that out and kind of put into your own words 2 of the main thoughts that you pulled from that lesson on investing control. Number 6, explain why inflation is desirable for the federal government. Right? So you may need to go back in and watch that video on this, but the basic idea that I'm wanting you to talk about is how debt becomes much larger if there's deflation. Right? As long as the price of everything keeps going up, the debt that you had from your past will eventually, little by little, feel much smaller, and it's much easier to deal with. Whereas if the price of everything is going down, then that means the amount of taxes coming in is going down because the price that people are spending on stuff is going down. And so the amount of cash out there is dwindling. And then all of a sudden the government has a whole lot less coming in, and it makes it very difficult for them to pay off their previous debt in a deflationary environment. So they intentionally do things with the printing of extra money and flooding the market with cash as needed to ensure that there is some level of inflation. Number 7, in your own words, explain what it means to create an investment cycle. So basically what I'm wanting there is, this is another one I want you to do on your own, but the idea here is I want you to go back and look at that video and talk about the principles involved. You don't necessarily have to do the same exact 2 investments that I did, but I want you to talk about that principle of what it means to have an investing cycle. Number 8, list and describe the 2 alternative investment types given in class. I'll give you the 2, right? And then you can kind of maybe go back in and look at them yourself. But the 2 are, one was investing in your own business, right? And then the other one was investing in real estate rental properties, right? So those are the 2 alternative investments to the traditional investments that you would be, the advice you would be given in like a financial house, where they try and put everything into the markets because then they get a commission on everything that you've invested in those arenas, and they very rarely steer you towards anything outside of the markets. And so it's important to know that investing in your own business and investing in rental properties are just as effective, and probably for most people are going to be a much better place to put your money. Alright, okay. Number 9, explain the difference between investment volatility risk and inflation risk. So if you remember, I talked about how there are these 2 major kind of risks. Investment volatility is the price of the stocks could go up, they could go down, they go back and forth, and so there's certain risk that your overall price of the stock could go down. So that's investment volatility, the changes in the price. Right? Inflation risk is that if you put your money in an investment that you can't adjust according to inflation, then it's going to erode your returns, and so you have to factor that in, because most financial places will not factor that in. They're just going to tell you what the returns are without factoring in the fact that inflation has really affected. When they show you a 10-year chart and they say if somebody put in $10,000, now they'd have 16. What's hard for us to envision is how much 10,000 would have felt like 10 years ago. as opposed to today. How much was the spending power when gas was $1, 20 a gallon, as opposed to $2 to $3 a gallon now. That through inflation, that 10,000 that you put in at the beginning of the 10 years would have felt very large, and so you may have made 6,000 over 10 years, but when you factor in inflation, it's much lower than that in terms of actual spending power, right? So that's your two risks, and the reason it's important to know that is because almost all of financial advice is centered around managing for volatility risk, and not much at all is centered on how to put your investment dollars into places that you can adjust for inflation so that you don't have to deal with the inflation erosion that takes place in the financial markets. All right, number 10. Why do most financial advisors not advise a portfolio that is genuinely diversified? So I touched on that just a little bit in our talk here, because they don't get any commission on things that are outside of the financial markets. If you go buy a real estate property, your real estate agent gets that commission, not your financial advisor. So they're not steering you towards that stuff. They're only advising you. The scope of their advice is generally limited to the things that they can get a commission on. And so that limitation causes them to give advice that's not in your best interest sometimes. Not that they're trying to cheat you or anything like that, but their range of investments that they're going to offer you is limited, and then that ends up, kind of keeping you from certain investments that probably would have been better than the financial markets, especially when you're first starting off. All right. Number 11, explain in your own words why it is important to view your own small business as an investment opportunity. Right? And so I'll kind of leave that to you. I talked on that a little bit, but it's the idea, I'll give you one of the things that you should probably include in that. It's the idea that this is where you're going to draw your salary, right? So if you're going to want anything to be well-funded and stable and, a place of where you're going to invest, the Bible says you sow where, you reap where you sow. So if you're planning on reaping a whole lot from your small business, you need to make sure that that's where you're sowing. All right, number 12. This is a shorter final, but if you'll notice, I gave you a larger proportion of these that I expect you to go back in on your own and put these into your own words. Right? Number 12. Describe 2 important financial benefits of investing in multiple real estate rental properties as a form of investment. So I want you to go back in, look at that. I gave you several about what are the advantages of doing a rental property, right, as a form of investment. I think it's in my mind, it's a better place to start than the financial markets, right? And so I want you, and I explained why in one of the videos. So I want you to go back in, think through that, and be able to put into your own words 2 strong aspects of getting into the rental property market that make that an advantageous investment opportunity, right? Okay, so go back in. You've got quite a few that you need to watch your videos on, but the balance of that is that it's a short final, right? So it's only 12 questions, but half of them are, longer kind of answer questions where you'll need to, fill them out in your own words, kind of paragraph style. But overall, you should be fine. If you have any questions, feel free to send us an email.